Well, welcome everyone, and only a few more topics to go. And I know we actually go a week longer than most other classes. Get more value for money, you could argue. But we do go a little bit longer, so I know for most classes you finish next week in terms of the new content and you go into revision. We've still got 3 to go. We've got leases today, we've got tax next week, and then we've got cash flows the week after. Leases is quite an interesting topic to look at because it's one of those ones which is very topical from a regulatory point of view. They released an exposure draft. So when I say they, the AASB released an exposure draft last year looking at leases. It's the second time they've released an exposure draft in relation to leases. First one had a lot of issues with it, so they went back and tried to sort it out and re-released it. But there are some significant issues that they're trying to deal with in this. There are significant issues, they're substantial in terms of economic effects, and they are real. So that's what we're going to be looking at today. But to look at why there's an issue, we have to understand how the accounting works at the moment and then what this actual problem is. If you flick through the slides already, you may already have a sense of that, but we'll obviously talk about it anyway. So leases. What is a lease? I dare say most of you have probably leased something in your lifetimes, or rented something or used something. You know, most of us have. I'd be really surprised if anyone in this room has never leased something or rented something in their life. I'm pretty sure we all have. Why is accounting for leases problematic? What incentives there are for lease structuring? And this is why this is an issue. This is why the AASB is looking at this particular issue, because the way the regulation currently is gives really strong incentives for companies to structure certain transactions in a certain way. And we're going to see the effect of that. We're going to look at the regulation around how to account for a finance lease, how to account for an operating lease, and how to account for a sale and leaseback transaction. All said and done, we will be out of here well by 8 o'clock, so let's get into it. I rent the place that I live in. You know, if you're not living at home, unless you happen to be an owner, you're probably doing much the same. So we know what leases are. I mean, if you don't lease your place, we have different sorts of leases, so we can lease a property. Anyone been in a video store lately? Like actually inside a actual video store? What's a video store? They do exist. They're kind of like, I would say, does anyone remember bookshops? Bookshops still do exist. The things that don't really exist, and I was really surprised to see when I went in London, has anyone been inside a record store, like not necessarily selling records, but sells CDs? Has anyone actually been inside a sort of CD shop, like a standalone CD shop, not part of sort of a small CD section in Myer or something like that? You know, HMV's gone, Sanity's gone. Like, you know, they're the small independents, but they're pretty hard to find nowadays. Records. Video stores have gone much the same way. My local video store went a couple of years ago. And it makes sense because I mean, you can get this stuff online. You can pay for it legitimately online. You can not pay for it online and get access to it. I was a good boy. I paid the additional money on my Foxtel subscription to get Game of Thrones. So I didn't get it from other sources, which I know is possible. Not to say I didn't do that stuff in my youth, but I just feel it's the right thing to do to pay for things. It took me a long time to start for paying stuff online. I mean, after being used to getting free music for so long through the various services, to actually pay for music online was a bit weird, but you know, I don't want to get in trouble because would you guys have been, this is making me sound old. Do you remember when Metallica sued Napster for providing stuff online, and Napster ended up shutting? Has anyone of you heard of Napster? Some of you might have. Yeah, it was basically a really good way to get free music, and they ended up getting sued by Metallica. No more. But anyway, a lease is just simply an agreement whereby the lessor conveys to the lessee in return for a payment or series of payments the right to use an asset for an agreed period of time. That is a technical definition in the standard. And we know it. I rent where I live, and that for monthly rent, I get to live there, so I get something in return. You go down to the Video Easy kiosk and you pay your $4, whatever it is, You get a DVD for a day and then you return it, hopefully on time. If you don't, they'll just charge you another $4. You get for a payment a use of an asset. Now, a use of an asset for one day being a DVD versus using a property for 6 months, a year, you could say they're sort of different things, but realistically those things will be much the same in terms of the economics of them. You can go off and rent cars and hire cars. And again, that's going to be much the same. You're going to use them for a short period of time. You're not really going to own them at the end. You're just going to use them for a little bit and give them back. But we know there are different sorts of leases. Radio rentals, if anyone's heard of, allows you to rent and then to buy off the end of that. So suddenly we're looking at a slightly different situation where you can lease that asset and then potentially buy it at the end. We then move into situations like a lot of airlines have, where they will actually lease a lot of their aircraft. So Qantas actually, they do own a lot of their property, plant, and equipment, but they also lease a lot of their property, plant, and equipment. So they may not technically own the airplane that you're flying on. Now, they may not necessarily own it, but as we go into it, if you lease a car for a day, you may just do it for a day, or you may do it for a week. When we went around Europe last year, we leased a car for 6 weeks. But again, we had to give it back. It's still a small part of the overall life of that car, you'd hope, unless we write it off, and then that was the life of the asset. But for an airplane, they may lease an airplane for 15, 20, 25 years. They may actually lease it for a very long period of time. They may look after the airplane. They may do all the sort of proper maintenance and proper, they may insure it. They may look after it. They may do all the things which looks like an owner would actually do. The money that you're going to spend on a car is probably a very small proportion of the overall cost of that car. Whereas when you look at the amount of money that an airline may spend leasing a plane, that's starting to look like they're spending a lot of money actually doing that. So you're starting to get into more of a situation where it looks like you, for all intents and purposes, own that plane. And that's what we're getting at. It looks more like a control situation. Generally, the asset is returned as long as it's in good working order. The asset might be kept at the end of that. So it's one of those ones where you may actually keep it at the end. If you're going to be renting it and then keep it, that looks like, again, there's an ownership situation starting to evolve in that. It might be a really specific type of asset. Now, an airplane can be used by different companies, but it may be a very specialized piece of machinery which you're renting. The person renting it to you can't really take it back and really lease it to someone else. So it again looks like it is being developed for you. This is important, and this ties back into what we were doing last week with equity and liabilities. So you may have something which is technically talked about, it's sort of financial instrument which is discussed as equity. So it might be some sort of instrument which is a share or preference share or something like that. But when you actually look at what's happening there, it actually looks more like debt. What we're interested in and what accounting is interested in is the economic definitions. So what actually is the substance of this situation? Just because you say it's X doesn't necessarily make it so. It's actually, what does it look like that's important? And it absolutely does matter, because if you do not technically own something, then you do not show that on your balance sheet. You do not show that asset there. But if you, for all intents and purposes, control that asset, then you do. Now, just a quick, how many of you guys are doing ABC right at the moment? Okay, so a few guys. So and you guys do it Wednesday night, don't you? Back to back, middle of the week, 3 hours of accounting, actually 6 hours all up, good times. When you think about consolidating a subsidiary, what is the thing that you look at to whether or not you can consolidate it? Yeah, it's control. Does that mean if you own an asset, if you own that company 100%, do you necessarily have control? I know that's not for this subject, but Yeah, so it doesn't necessarily, just because you own a company 100% doesn't necessarily mean that you control it. It's probably a pretty good indication that you do, but it's no guarantee that you do. So you're not necessarily looking at ownership, it is the control and the voting rights, the decision-making ability, which is the important aspect of it. And the reason I bring that up is, if you guys are interested and have a little bit of time, have a look at Telstra's annual report, the most recent one. They have a company they own 100% and they do not consolidate, because even though they own it 100%, they only have a 44% control, 44% of the voting rights on the board, and as such they see it that they do not have control at board level. They do not consolidate that entity, but they do own it 100%. So it's one of those things. It's not necessarily the legal aspect which is important. Now, why this is important is we want to make sure as much as possible, and this is why having a framework is really, really important. If you have transactions which effectively do the same thing, you want to make sure that the accounting for it will look the same, even though they may be technically called different things. Because if you don't do that, if you allow two different things, even though they end up having the same effect, to be dealt with differently, you're going to give almost an arbitrage opportunity for companies to say, well, if I do it this way, then we get to show these sort of effects on a profit and loss statement and on a balance sheet. But if we do it this way, then it's going to look like this, even though they will give us the same outcome. And what we're talking about there is a lease situation versus a borrow and buy situation. So imagine if I need to buy an airplane. Because I mean, airplanes are a common one we're going to be talking about. And that airplane is going to cost me $100 million. I could go down to the bank. Well, I couldn't. They're not going to give me $100 million. But say I went down to the bank and say, look, I need to buy this plane. And they lend me $100 million. So I would debit cash 100, credit liability 100, bank loan, whatever you want to call it. I would then go and buy a plane for $100 million, debit asset $100 million, credit cash $100 million. You net those out, I've effectively ended up with an asset of $100 million and liability of $100 million. Now, a lease situation is almost cutting out that middleman, where instead of getting the finance from a third party, you're just getting the finance through the company that you're getting the asset from. And so you're actually still ending up with an asset of $100 million, and you've effectively ended up with $100 million of debt. So we need to make sure, if that sort of situation happens with a lease, that we show the fact that there is debt there. Because if we don't, you're going to really push companies to use lease transactions to finance their asset purchases. And we are seeing that happen. And that is why the AASB are pushing back against this. This is something that is not just an academic idea that companies who go down this track. We actually do definitely see it happen. So to give you an idea with Qantas, they've got assets of about 20 billion. They've got property, plant, equipment of about 14 billion. So it's around about 70% of their asset structure of property, plant, equipment. And given it's an airline, that makes a lot of sense. I mean, they've got a lot of planes. Of those planes, of their assets, about a quarter of those recognized assets are leased. So they don't own a quarter of those, a quarter of that property, plant, and equipment. Their liabilities are about 14. The thing which is the issue are these guys. Feel free to have a look at it. I mean, it is useful to go and have a look at annual reports. It's why we set up the bonus assignment the way we did. We want you actually looking at this stuff, because it's all well and good for us to talk about it and throw some numbers around, but actually see what's going on. You'll often see a lot of sort of strange things happening. They have, and we haven't talked about what operating leases are, but the important thing is that $3.389 billion is not recognized. That money, that amount is not part of the total assets, is not part of their total liabilities. It is a disclosed amount, it is not recognized. Now, we'll talk about what an operating lease is in a few moments' time, but non-cancelable suggests that you can't cancel it. Now that suggests if you want to get out of that agreement, you're going to have to pay to do so. Now if you think about what a liability is, a liability, you have that present obligation. Now that is a back of the envelope calculation, and if you have a look at note 28, you'll see why that's the case. But I mean, even if you sort of ballpark it down, you're talking about $3 billion thereabouts. That is something I believe is a liability. The AASB believe is a liability, and quite a lot of people around the world believe that that's a liability, and it is not recognised as such. And that is the issue that they're trying to solve, because companies, if they can structure it in this way, will push these things into these type of operating leases because it gets it off the recognised accounts. If we build it back in, leverage moves from about 70% up to about 75%, and that's a substantial increase. And so you can already think about the reasons why companies would want to actually change their leverage ratio. And hopefully you're looking at that and thinking about the contractual reasons, thinking about the decision-making reasons, why that's important. But it absolutely is an issue. So why is accounting for leases problematic? Because of this divergence between economic substance and legal form. So what an asset is, I know it's coming back to the framework, but it is useful to think about this before we move on. So an asset is a resource controlled by the entity as a result of past events and from which future economic benefits are expected to flow. A liability is a present obligation of the entity arising from a past event, the settlement of which is expected to result in an outflow from the entity. And the framework is very much an economic model. We expect to see lease capitalization when you have control of that asset.